Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly video with our friends at Strategas. Today, we are lucky enough to be joined by managing director and senior technical strategist Todd Sohn. Todd, how are you doing today?
Hey Ross, I'm great. Always a pleasure to speak with you.
Good to talk to you as well. Let's start with some good news, which is we're in the midst of a really impressive rally off the April 8th lows. If you could put the move into context and then tell us what it means for forward returns, that would be a great way to start.
Yeah, great question. We are just about 3 months off of the low, and we are among the best historically in terms of the percentage change. The snapback rally has been one of the best and fastest rallies back to a new high for the S&P 500 in history. What does this mean? Historically, every major market low has been accompanied by one of these price momentum extremes. Now, in the next 1 to 2 months, the returns are a coin flip. They're sloppy, hard to get much of an edge. But as you go further out in time, 3, 6, and 12 months, all of these observations give you a very high probability that we're going to get very strong, perhaps above average returns with very good hit rates. So I think the point here is don't be too scared of too far too fast. Too far too fast, especially coming off of correction lows, is actually a very bullish signal for investors. Yes, you can get some setbacks in the near term. Maybe rates are the kind of the catalyst for any sort of summer misstep. But keep the big picture in mind. It's a very bullish setup that we have now that we're 3 months off of that low.
Yeah, and entering a seasonally tough period as well. So good to keep in mind to think big picture. I want to focus on two things about this bull market and kind of contextualizing it. The first being we have this big rally off the lows, and for a year kind of prior to that, tech had not been leadership. And over the last couple of months, we've seen the AI trade and big tech really come back with a vengeance. Talk about if that's good or bad, and then contextualize it with the concentration risk that it feels like we talk about every 6 months for the last 10 years, but it is creeping high again where those big mega cap names are leading the pack. Is that a risk in your eyes?
Yeah, I love this question. So tech has stormed back, particularly off the back of semiconductors. And semiconductors is about a cyclical index you can get there. We like that the semis are back on the playing field. And that's also being accompanied by strength from financials, strength from industrials, and strength from discretionary over staples. So the leadership backdrop is good. As for tech, so yes, semis are driving it, NVIDIA, Broadcom, stuff like that. But you did see a pretty good expansion in the number of tech stocks hitting a new 3-month high recently. So it's more than just these big names that are participating from tech. As for the concentration aspect, it's great for investors that these big stocks are working, but I think you just have to pay attention to what you own within a portfolio, right? There's a lot of crossover, especially within very popular ETFs, whether they are your standard cap weight blend funds, growth funds, even quality to some extent. A lot of these ETFs can own the same, so you may have more exposure to a small core of names than you'd like. Is it a risk? Not necessarily until things actually turn, right? We don't know when that will be, but I think it's more of a due diligence. If you're loading yourself up on ice cream, eventually that's not going to be great for you. This might be the analogy here. So just understand what you own and how much of it is. We're okay with the leadership backdrop, but I am a little bit worried about this continued movement back to the concentration risk, back to these top 10 weights, and especially among the crossover of a lot of popular funds that are out there.
Yeah, just good to keep top of mind. And as you mentioned, I mean, big tech is working, but a lot of other stuff is working. It's just not nearly as sizable, so it doesn't get the headlines. The other thing about a bull market, it starts almost always from a point of huge negativity, right? And April 8th was as negative as markets had been in the last 5 years, if not the last 15 years. Is that starting to turn, and is sentiment starting to become a risk? Are you starting to see in some of your work euphoria or big risk taking start to creep back into the market in a way that might be less positive for risk asset returns?
Yes. So in our flows work, looking at ETF movement every day, where money's going, you've started to see some demand pick up for equity exposure and particularly cyclicals. But there's a lot of room to go before you sort of get into any euphoric territory or any really risky extreme territory like we had at the start of this year. So I'm okay with the increase in flows to some of the more risk-seeking sectors. I think that's natural given stocks are basically back at new all-time highs. but we are a far different backdrop in terms of sentiment today than we were at the beginning of the year. And I think that's a really important distinction between the new high today and the new highs at the start of the year. It was a very extreme sentiment backdrop back in January. Tariffs kind of lit that match and wiped out that sentiment and positioning risk. Now we have a much different backdrop. So yes, sentiment is getting a little hotter, but it's more noise and neutral, I think, than any sort of big flashing red light today. Of course, we'll keep an eye on that, but I'm okay with it for now, with the demand for some of these areas picking up.
Yeah, you need bulls to have a bull market, so it's a good sign that people are coming off the sidelines. Todd, thank you so much for the insight as always. We'll look forward to talking to you again soon. Have a good one.
Hey, you too, Ross. Thanks a lot.